everything that you see on the news. With everything that you are seeing on the news, to help identify, how those things are impacting your accounts, and how it aligns with the thinking that we have, and ultimately how those things should impact any investment assets that we discuss or we're able to work with our clients. So as Jason mentioned, this is the first time that we're opening this call up to people outside of our network. So we obviously want to share the information and the data that we see to not only help the clients that we have currently, but also, maybe to connect with some new clients to be able to answer questions and be thought of as a resource and a partner if we have the opportunity to visit with them again in the future. So out of respect for everybody's time, I'm going to jump right in. But if there is a question, please don't hesitate to shoot it in the comments. This is being recorded, and we will provide a copy of this afterwards via email. So thank you everyone for joining. All right, we're going to kind of come at this from a couple of different angles. The first angle is, where have we been? What have we experienced for the first part of the year? And we're going to look at that through 4 different components: the stock market, the bond market, interest rates, and the economy. So this is the big one, right off the top of the bat. This is what you see on TV when you go to get your stock quotes. You see the S&P, you see the NASDAQ, and you see the Dow Jones. And obviously, when you look at these and where they've been throughout the year, there's a lot of green, right? There's been a lot of green. We had a tremendous first half of the year, but a lot of times there's a lot going on behind the scenes there, and I think it's important to understand the components that make up these factors. And as we talk about, and move through the presentation, I hope that's going to become more transparent and clear exactly what is behind these numbers and what's making these numbers move up or down on a daily basis. So obviously you see the generic stock market, the headlines. When we look between the lines and we start to figure out what's going on behind the scenes, I'm going to point out a couple of different things. This is the sectors of the market. This is the 11 components of the S&P 500, and this data is as of Friday. And when you start to look and really see what's going on, you see there's really only 3 sectors here that's driving the year to date. And I won't bore you with a lot of historical stuff. All of this stuff you'll have again as after the call. But when you look at what's really been driving the market, you see it's very top heavy, right? You see a lot of performance in communication, information technology, and consumer discretionary. And as we go, we're going to start to identify the individual components of these sectors to break down even further so that you can see what's driving the market. But what I think is incredibly interesting is when you start to look at the positive market performance, really all of the sectors except 3 are underperforming the numbers that you see on your financial websites that talk about the performance of the S&P and the NASDAQ and the Dow. Industrials are still the best performing sector under those 3, and it's just barely over 4% for the year. And you've still, as of this week, have 4 sectors of the market that are actually negative for 2023. So from a component standpoint, again, you've really got a couple of sectors driving the market. This is kind of breaking down a different way in how we look at it. And I like to look at the S&P 500 equal weighted index, because this one just takes all of the 500 stocks of the S&P 500 and weights them equally as opposed to market weight. There's some charts that I look at where the top 5 or 6 stocks are now about 30% of the S&P 500. So when you think you're buying an index like the S&P 500 and you're expecting diversification, you are getting that to a certain degree, but you've still got 25 to 30% of your dollar is invested in a handful of companies. So, if you really want a better representation of what the market as a whole is doing on a broad scope, you can look at something like an equal weighted S&P 500 index, and you can see the performance is just barely positive. It was actually negative until last week. So it just turned positive after last week's performance. So again, looking at that compared to what you see when you see the headlines at the previous slide, the S&P as a whole was up almost 14% for the year. Again, it's going to be driven by just a couple of stocks. And those stocks that everybody's familiar with is the big 7. It's Facebook, Amazon, Apple, Microsoft, Google, Tesla, and NVIDIA. When you look at those companies, and this is a couple of weeks old here, But when you look at those particular companies, they're up 53% year to date. The remaining 493 companies are, again, as of last week, were negative. They just turned positive, but according to this, as of June 1st, they were at zero for the year. So again, you really see what's driving the market. So if there's any dislocation between your portfolio and what you've seen from a performance standpoint and the data that you're seeing on TV, hopefully this is going to help you shed some light on why that discrepancy is there. But when you consider those stocks and you think, okay, well, we should be moving into things that are performing well this year. But I wanted to show you what those same stocks looked like last year. And when you compare those same stocks that have outperformed this year, last year, those companies were collectively down 40%. So, you really have to have a diversified and a balanced approach as investment managers. We want to be students of the market, but not stock pickers, because there's a whole lot of risk. So you have to really have a strategy and a sound fundamental balanced portfolio that's weighted in areas that are favorable, but is not chasing returns, because in order to do that, you would obviously have to take the volatility that you've got in previous years. So it's a long-term game. You don't want to really follow the things that are working now to a heavy degree, because those things might turn around and be the worst performers in 2024. To the point of the S&P 500 equal weighted index, this is a chart that Value Line puts out. This is the average stock. It really just is weighted for all of the about 3,000 stocks that's traded in the market. And it's really just an index that's created to see what the market as a whole is doing. And you can see, this again is a couple of weeks old, but this is 2020 here. And I put this line on there so that you can see again, before last week, it was still down. So the average stock, again, has not performed well and is not even back to where we were before 2020. Again, we're starting to get there, and I think we're moving in the right direction. But for the average stock's perspective, unless you were in one of those 5 or 6 high performing stocks that we talked about in the previous slide, it's definitely been a challenge. All right, turning now to the bond market. This has been an incredibly challenging thing. Certainly, we all know about interest rates, and we've seen what's happened. Historically speaking, the bond has been, or fixed income as a whole, has been considered relatively stable or conservative. It's been a portfolio diversifier. It's been something that's provided safety. Traditionally, when stocks have been up, bonds have also been up. When stocks have been down, bonds could also be up to provide some stable, consistent returns. Well, when we see what's happened based on the rise of the interest rates, bonds now have declined almost as much as stocks declined in 2009, which when we go back and we talk about March of 2009, that was the financial crisis. So, we all know what happened to stocks at that point. We were down about 55, 58% in 2009. Well, the treasuries have done the exact same thing. They have now almost eclipsed, or they just have eclipsed the declines of stocks. So, it's been fundamental shift in determining, what kind of creates balance and diversification, because the assets that people considered safe have created stock-like drawdowns, and it's created a real challenge to understand the market and portfolios solely driven by the rise in interest rates. And I think this is a great quote. This is from a money manager named Mohammed El-Arian. It says, in terms of total returns, this is the biggest bond market rout in 150 years. Last year was in fact, U.S. investors' worst year since 1871, with total returns of minus 15.7%, even worse than the annual returns of 2009. For 2023, the year-to-date return has been almost negative 10% annualized. That's minus the 17.3%, even worse than in 2022. We're looking at bond investors' 2 worst years in a century and a half. So I think that pretty much sums it up. And, it's really, again, been a challenging market for bonds. And what's the reason? We all know what the reason is, right? It's a math equation with fixed income. They have an inverse relationship to interest rates. When interest rates go up, the value of the bond goes down. So, as the Fed rose interest rates, that has really had a significant impact on bond markets. So as we sit here today, rates of treasuries are over 5.5%. the federal funds rate is now 5.5%. And what you can see, and we'll show in the next slide, it's had significant effects on not only bonds, which we saw, we also have seen the impact that it's had on things like mortgage rates and things like the housing market and even the stock market. And the main reason is because not necessarily the rise in rates. When we look at some of the data historically, the market doesn't necessarily underperform when rates rise, but the biggest impact has not been the increase, it's been the speed at which the rates have increased. And when you look at the increases that we've had over the past year to year and a half, all the way up to this year, you can see they have been the highest in history, going back the last 40 years. So it's really been a shock to the market and the economy as a whole. Historically speaking, though, the returns, or excuse me, the yields are just now back to average. I think this is pretty eye-opening to really help put things in context. It's been a significant impact to us because, again, the speed, but when we look at where rates are, historically speaking, they're just now back to average. So when we see things on the news like higher for longer, I think this is a big reason why. And I think we're all kind of getting adjusted to it now. It's certainly had its impact, but I think we can expect rates to kind of continue along this path into the future because historically speaking, they're right where they have been, going all the way back to 1790. All right, let's take a look at the economy. This is obviously a big factor in any market. It impacts stocks and bonds. Let's take a look at the economy and some of the things that are happening so we can really understand and how to interpret that data. Let's look at the positive. We just had some really good GDP numbers. It came out at 4.9% was the last announcement. That's tremendous. You can see going back, we've really had the moderate GDP growth starting in 2021. It's really jumped up. So 4.9% was a big shock. It was well above expectations, and I think it was the first estimate. These are revised a lot of times, but if we can continue to support that 4.9%, I think it bodes very, very well for the trajectory of the economy. The other positive has been employment and wages. That's a big, big factor. We haven't experienced a significant decline in job listings. And we have experienced wage growth. We've had positive in both of those. So the economy as a whole, from a health standpoint, looks pretty good looking at certain metrics. The bad, this is kind of the foundation of recessions, right? Leading economic indicators. But this is not terrible because you can see the last reading, it's starting to turn up. Obviously, there's been a lot of talk. Are we going to have a recession? Are we not going to have a recession? When things are declining like this, you typically expect to see a recession. When you look at the past recessions, it has been when there's been significant declines. This was 2020. So it's not an unpopular sentiment that we would expect a recession, but the last reading for the LEI has indicated that the economy is recovering and moving in a good direction. So we're still not out of the woods yet. So that's kind of why it's in the bad category. It could very easily be moved into the good if we continue to get good economic news. Manufacturing has been challenged, right? We've struggled with it. You can see that there's a divergence in the manufacturing index. So we're a little below average. I would hope that these things would continue if we can continue to get improvement here. Now let's look at the ugly. I think we all know what this is, right? U.S. home sales and mortgage rates. This is a big one. Rates have almost topped 8% on the 30-year. They just bounced back a little bit this week, but the week before they were at 8%, which obviously has had a significant impact on home sales. We're at the lowest levels we've seen since 2010, 2011. So again, the market is going to have to adjust to this moving forward. If we think rates are going to remain about where they are for the next year or so, this is going to be something to watch. And then the most significant impact, right, with the ugly, I think, is the debt ceiling and the amount of debt that we have. This, is really transcends political party. It goes up whether it's Republican or Democrat. But this is a significant problem. Down here, we're at 129% debt to GDP ratio. 20 years ago, we were at 56%. So, this is something that's going to be a problem. The question is when. I don't anticipate we're going to get any reduction in government spending, regardless of who's president or which party controls which house. I think this is something that's going to have to be dealt with at some point. And I don't know what the solution is, but it doesn't look like currently anybody has the will to even address it. So this is something that we always watch. It's going to be a big, big problem. So where are we today? And what do we think about what's going on right now? Again, despite the headlines, we've seen a lot of things that are causing people to get concerns. But historically speaking, we've only had a drawdown of 12% this year from peak to trough. Historically speaking, that's well below average. So, even though we see the things that we see on the headlines, it's important to keep those things in context. And the amount of volatility that we've had this year, looking back, has been pretty moderated. The probability of recession is now under 50%. As of a couple of weeks ago, it was over 50%. So what this basically means is that more economists are now predicting that we will not have a recession than are going to have a recession. So again, it's still pretty close to 50-50, but you can see earlier in the year, we were much, much higher. So again, from an economic perspective, this really aligns with some of the positives that we've seen, and we've continued to get good numbers. So the probability has now been adjusted. But I think it's important to, again, keep those things into perspective, right? Let's assume that we do have a recession. What does that mean? And I know there's a lot going on this slide, but I'm just going to point out some of the average returns. On average, going back to 1953, the market return during recessions is only down 1%. But 6 months before, it's down 2%. 12 months before, it's down 3%. So what this is telling us is that when we're in a recession, the market returns are better than the returns you got 3 and 6 months prior to the recession. So if we are going to have a recession, it doesn't necessarily mean that we should dump all of our stocks because the market is going to crash. What the data has shown historically is that the declines have largely been before we were actually in a recession. But when we shift to 6 months after a recession, you can see the returns are positive 7% on average. 12 months after, 16%, 2 years after, 20%. Now, this is important because recessions, when you look at the actual definition and when they're classified, they don't typically report until 3 to 4 months after recession. So basically, by the time the data comes out, you're already here. So you don't really know you're in a recession until after it. So it's important, again, to focus on strategy, to understand where you are, and don't, kind of separate the headlines from making financial decisions with your portfolio. I thought this was a remarkable chart.
Doug, real quick, do you think that the reason why performance in recessions is typically better than even the months leading up to it is because of the human wiring that we see when people have clarity, I guess, like meaning once you know you're in a recession, then it's for lack of a better term, there's clarity in the situation as opposed to leading up to recessions. There's often a lot of what we're seeing right now, which is all this drastic uncertainty. It's almost like a level of certainty seems to drive the markets.
Well, I think that has a lot to do with it. I mean, there's one pretty common fundamental, really mantra of the market, and that's it hates uncertainty. The market prefers bad news to even uncertainty. So once you start to have certainty coming out with anything, whether it's earnings or economics or recessions or interest rates, and you can really see it with the Fed's announcement of interest rates. The market reacts better when the Fed makes an interest rate announcement one way or another than it does when the Fed says, we're going to watch and wait, and maybe there'll be an announcement next month. So just having a little bit of clarity really helps people understand and position and how to make financial changes to impact their portfolio. So I think that's a great point because uncertainty is really, really detrimental to the market.
Understood. Thank you.
So when we look at this, we're in the third year of the presidential cycle, and I think this is a phenomenal chart. When we look at the way the market has performed, this is the average third year of the previous 19 presidential cycles. So this line is the average market trajectory if you average all of the 19 previous third-year presidential cycles. And when you compare this to what the market has actually done in 2023, you can see it's incredibly similar, right? It's almost following line for line. The market peaked in July, then we had a drawdown, then we had another drawdown. Today we're at about 215. So day 215, there's 252 trading days in the year. So, you can see where we've gotten one of the best weeks. And again, the market continues to really, really align with the exact returns of the historical cycle of third-year presidential years. So, again, despite the challenges that we've seen, the market has really performed exactly the way it has in previous years. And I think that that's pretty remarkable. This is something that really goes to Jason's point. There's a lot going on in this chart, but the reason I put this on here is because, really focusing on sentiment. When sentiment is the lowest, that's when you get the best returns. When sentiment is the most positive, that's really when you get the least returns. So, you have to think of the market and investments the same way you do, shopping on sale, right? When, everything's on sale and it's the year-end clearance, that's the time to buy. But it's a hard thing to do financially, because I know that, that makes a big impact on, people's buying decisions. You typically buy in the market when everything's great and you feel good. Historically speaking, that's been the worst time. So again, you want to separate what you're seeing in the headlines from, really making financial decisions, because that's really goes counterintuitive to where historically the best opportunities have been. So this is the most important, right? Where do we think we're headed, and what does the data look like to support those things? Again, we always start with rates, because that's been a significant impact and a driver of the market so far in 2023. This is what a normalized yield curve looks like. You expect the rates on the longer ends of the years to reward you more than rates on the shorter end. So this is what a normal yield curve looks like. We obviously know that yield curves have been inverted. And for those who do study the markets, yield curve inversions have always, except for once, historically preceded a recession. So, it's really one of those things that's caused people to say we're going to be in a recession, is based on the inversion of the yield curve, this being upside down. But you're starting to see things normalize. This is last year and this is this year. And the important thing, and the thing that we want to see, is even though the whole chart is shifted up, right, with a rise in rates, what we want to see is this on the long end start to move up here, so that these rates will stay about where they are, and we will start to get a normalized yield curve. And you can see that's starting to happen. Everything is moved up, of course, but we're starting to see some long end rates get to where they need to be, to a certain extent higher than the other ones, so that we can get a normalized yield curve. So this has been a driving factor of this yield curve going back to normal, that's caused the predictions for recessions to really start to come down. And here's the reason why. This is a survey of all of the Fed governors. There's 12 of them. This is where they expect rates to be. This was after the most recent announcement. You can see where all of them are voting rates going to be. Some of them as low as 4.4%, some of them over 6%, but a majority of them are right here, which is a little bit lower. But the important thing is, where do they think it's going to be in 2025, 2026, and then how long after that? And you can see all of them almost are unanimously saying rates are going to come down, which of course is a good thing for the market. So the Fed has done actually what it's designed to do, even though it's challenged and put a lot of stress in the system. It's really wanted to slow down economic activity. And you can see that with some of the charts that we talked about previously, things like housing, things like mortgage rates. All of those things have really slowed down demand, so that rates and the economy can slow to a certain extent and push that demand down and restrict supply, so that they can start to normalize the inflation rate. And then that's really working, and we can see that their expectations for rates to come down in the future. But what does that mean to returns for asset classes? We just had an announcement from the Fed regarding the rate hike, that they're not going to raise rates. Uh, this chart's a pretty interesting chart because it shows the returns of various asset classes after the last rate hike. So we don't know whether the last rate hike, and I think, Jason, to your point here, you can see that the market declines a month after the last rate hike, because I think typically the Fed doesn't come out and say, hey, this is the last rate hike, right? They come out and say, we're going to reevaluate next month, so that there's a continued decline in the market. But then after the next meeting, they say, we're not going to raise rates anymore. And that creates some certainty, and the market starts to increase. So you can see 100% assets, whether you're in cash or whether you're in stocks, are going to outperform once the Fed stops raising rates. So, is this going to be a pause? Are they going to have one more rate increase? Remains to be seen. But long-term impact, we can really see some positive performance, even in things like money markets, right? Even cash has a positive return 12 months after the last rate increase. So stocks are up here at the most positive. But again, you really have good returns after the Fed stops raising rates. And the main driver for that, and the main driver that we've seen the past couple of weeks, has been earnings. When you look at the expectations for analyst estimates for the earnings of the S&P 500 moving into 2024 and the last quarter of 2023, they're all incredibly positive. There's significant projected earnings growth. On average for 2023 has been 11.7%. The average from 2001 to 2022 has been 8.4%. So about a 30% increase in earnings across the board for the S&P 500. And if that's what we've gotten in 2023, 2024 is expected to be much, much higher. And if those things materialize, I think we're going to continue to see strong performance. Since we talked about the third year of the presidential cycle, I think a natural question is, what does the fourth year look like? This is broken down month by month, January through December. Year to year. And this is the trajectory of the fourth year. So again, if the third year has worked out exactly as it has historically, we, again, fingers crossed that we can get the same thing from the fourth year, because from a market perspective, I think we've had positive returns on average the last 19 fourth-year presidential cycles. And these are those years broken down by year, sorry. And you can see for the most part, we really only had a big drawdown in 2008, but the last fourth year, regardless of who's in office, has pretty much been positive. Here's the month-by-month chart of calendar year returns on average going back to 1970. You can see, historically speaking, you had a negative September. When you look at the way that has been going back to historical averages, if the market was up more than 10% through July, which it was, and August was down, which it was, the remainder of the year is up 100% of the time with an average gain of 9.9%. So again, historically speaking, even with all of the uncertainty and the things that have happened from an economic and political standpoint, the market has really acted in a fashion that aligns with the historical averages. And we've seen these things play out. In November is turning out to be an incredibly positive month. Historically, it's been the strongest month of the year. And then December has also been strong. So, fingers crossed, we can continue to get these data points align, and the market can continue to perform the way it has in the past. I always end with this because, a black swan event is something that you can't predict and you can't really see that impacts the market. So there's a lot of things that are out there, and there's things that could happen that we don't know about that, are unpredicted. And those things do have an impact on the market. So while we, Jason and I look at the historical averages and the trends, and we think, okay, things are going to work out this way, we're always cognizant and evaluating the things that we don't see that could impact portfolios. So even though we have a real long-term mindset and are very goal-oriented, we make sure every client's portfolio is aligned with their personal goals and expectations and risk tolerance. We're always conscientious about things that could come up that would impact those things. So while we do like to maintain a long-term mindset and perspective when we evaluate things, we're incredibly cognizant on some of the things that are happening on a short-term basis, day to day, week to week. So, obviously the fundamental purpose of this call is communication and help share some of our thoughts with the market. But we do these same things with our clients internally. So we are not static on those things. If we see things that do come up that would have an impact on market performance, and certainly the performance of our clients' dollars, we communicate those things, and we try and put all those things in perspective. But we also try and evaluate how those things, whether they're advantages or disadvantages or opportunities for us to position ourselves to take advantage of things into the future. So we are never static, and we're always proactive with the way that we manage money. I'm going to turn it back over to Jason here. He's going to talk a little bit about this, and then, kind of relate that to the way that we have these conversations with clients.
Yeah, Doug, this is for me, I think the biggest thing that jumps out, and thank you so much for the just the great education, is aligning with strategy, right? And so strategy it's I actually had a client the other day say, well, yeah, if we sell this stuff, we can just drop it in an index fund. And I laughed because I said, okay, great, that's a great plan, but what's the plan for all of that money? And knowing her plans, the index was probably not the right thought process, and so we had to walk through based on what she had already expressed she wanted to do, and the liquidity and accessibility of certain of these funds, and how do you adjust accordingly. And so I think it always has to go back to a plan, right? Like what's your strategy? What are you doing? You might have money that's for lack of a better term, set and forget it, and you can weather certain storms, and you're just looking at it as a long-term piece of money. But then there's other money that you might want to access at a different time. And so being out in front of these things and understanding what is going on, and then also where the market's headed, and not I guess, for lack of a better term, being reactive, but proactive is probably the best approach. And so another way to mediate, to kind of hedge your stress is to understand that you are working a plan, right? I think I always relate a lot of stuff back to health because it's what I grew up doing for the majority of my life. And oftentimes, as a trainer, I would tell my clients we have to trust the process. And sometimes you don't see things in the mirror, but you know that getting up and doing the work and sticking with the plan is going to get the weight off. Well, it's very similar to what you just shared today. There's so many historical trends, and while history is not a predictor of future returns, there's a lot to the history. There's a lot of things that have been duplicated over time, and then a lot of these things like the yield curve and certain charts and all the data that you're collecting together helps you form an educated decision. So we just want to make sure that when we share this data, people see this and they go, okay, if it's extremely fearful and everybody's freaking out, that's probably a good time, depending on my goals, to capitalize on certain things, right? This might be a great time because the market's going to move in a different direction, whereas I perhaps might have an opportunity to capitalize on that. But again, it always boils back down to the plan. And so, Doug, great stuff today. One thing I wanted to,
I'll point out one thing real
Yeah.
quick on this slide, Jason. My job is to, as Jason mentioned, is really, portfolio and investment analysis and helping ensure clients make positive returns. I obviously am able to do that through investments and strategies, and of course, managing the plan. But another big way that we're able to do that I think really aligns with this particular slide is, helping a client understand and how to manage the emotions that they're experiencing. Certainly, that's influenced by all of the headlines and the commentators that's designed to get clicks, right? To generate fear, whatever that's the case. What this particular slide, and it's one of my favorites, is the average investor return is 3.6% over the last 20 years versus the market's average return of 9.5%. Now, it's not uncommon for our strategies to compete or beat with the market depending on a client's expectation with risk. So, what do we see that accounts for the reason why a client's performance would be 9.5% versus 3.6%? And that's really, again, helping a client understand how to avoid making emotional decisions. And one of the ways that we can do that is through proper education and coaching, and help reassuring them that when you see things like the fear gauge that is published on CNN's website, that's at 19, helping a client understand that that means opportunity, instead of helping, instead of maybe in a previous relationship, the client would have gone out and sold because, they're experiencing fear. They don't want their portfolio to decline, and that's causing them to experience a lower performance, versus, trying to help reassure them that strategies are working. The investments that we've selected do have the proper characteristics to help them achieve their goals, and then to put things in perspective with calls and communication like this. So, all of this stuff is designed to help bring a client's performance that may have been low back in line with where it should be, and helping them be more profitable over the long term.
Thanks, Doug. Real quick, we'd love to open it up for questions. If either of you have any questions.
I do not. It was very helpful and informative. Thank you. Could you hear me?
Yeah, we did. Thank you, Jesse.
Jesse.
I know there was some issues with the link, and so I apologize for that. We're certainly gonna address that and make sure that we don't have that issue in the future. But for those of you who couldn't attend, that are going to be receiving this afterwards, thank you for listening, and we hope it's been valuable. If there's any questions that you have.
Real quick, before we wrap up, I didn't get a chance to mention this on the slide prior to this, but I think it's really important, and I want to state it for this group because it is on a recording. The debt, right? That was a big component, and I didn't know if the question might come up, but I wanted to make sure we address it before we get off the call. Debt and the assumption of what there's two ways they can pay for it. We can continue to sell more GDP. They can continue to raise and come up with interest rates, or what I would consider is perhaps the biggest concern is taxation. And I believe taxation is probably where the majority of the ability to collect that debt can come from, and that's taxing the citizens. And the majority of the folks that are going to listen to this call, paying attention to it, are usually the ones that are going to have the bullseye on their back. So while we didn't dive into a tremendous amount of that, I just want to remind everybody that along with our stance when it comes to your knowledge of digging into the markets and the data that supports that, is also taking an equally balanced approach of ensuring that over your lifetime you don't have as much tax leak out of your portfolio, because every dollar lost to unnecessary tax is it's impossible to make that up with returns, right? Those are just dollars gone for no reason if you're not mindful as to how you can manage those through your portfolio. And so, and a big chunk of that is blending the tax advantaged, the tax free, and the tax deferred balances inside of your account. So just a reminder for those individuals that when you see that big debt number, what that screams to us here at our firm is higher future taxes. And so we're oftentimes trying to work with our clients to make sure that we're looking at that collectively as well.
Yeah, there's only two ways, Jason, to address that debt. You can grow your way out of it, or you can tax your way out of it. And I think it's gotten to such a high figure that it's going to be impossible for a country with a mature economy like the United States to generate enough growth to consistently grow their way out of a tax situation. So if Congress isn't going to stop spending, what that's ultimately going to mean is higher taxes for our clients. And so that's an important point that we focus heavily on doing everything we can to mitigate the impact from a tax standpoint with our clients.
Yeah, I think just a lot of times people forget, right now the highest effective tax rate is 40%, but if we look at our nation's average, it's been closer to 60. And so people forget that there was a time just 30, 40 years ago when, really about 30 years ago, when people were paying 60%, 70% tax if they were in the highest tax bracket. And what that means for those individuals that are in a, kind of a moderate to normal tax bracket it was probably 10 to 20% higher. So it's not far-fetched to believe that could be the case down the road. So anyways, just a refresher and a reminder to always pay attention to everything, including your taxes along with your portfolio. So thank you guys for those that joined us today. And again, we recorded this, so we'll be sending this out and continue to try to bring value added information to you going forward. Doug, thank you so much for the continued work that you do here at the firm and always being out in front of this information to deliver for our clients and for the opportunity for the individuals that are interested in, knowing more about what we do. They can always come to us and find answers because you are always in front of it. So thank you for that.
Thank you.
Thank you.